For 2 decades, the American dream was built on a simple, unspoken mathematical certainty. Real estate only goes up. You buy a house, you wait 5 years, and you walk away richer. It was the ultimate glitch in the financial matrix. But in 2026, that rule didn't just break, it shattered. For the first time in nearly 20 years, the machine is moving in reverse. Right now, the data is flashing red. 47 out of the top 50 cities in the United States are showing critical signs of weakness. Google searches for the phrase, "can't sell my house," have violently spiked, hitting an all-time record high. Today, sellers outnumber buyers by a staggering margin of more than 600,000. The for sale signs planted in front yards across the country aren't just decorations anymore, they are warning beacons. Homes are sitting stagnant on the market for the longest time in over a decade. We are not just looking at a seasonal dip. We are not looking at a temporary correction. We are looking at the great housing reset.
And to understand how we got here, you have to look at the invisible strings controlling the global economy. To understand why your neighbor suddenly can't sell their perfectly good 3-bedroom ranch, you have to look 3,000 miles away at a barrel of crude oil. It sounds insane. What does the price of energy have to do with a suburban cul-de-sac? Everything. Oil prices and your mortgage are tethered together by an invisible chain. When the price of oil climbs above $100 a barrel, global investors begin to panic about inflation. To protect their wealth, they demand higher returns on long-term government bonds. This directly pushes up the 10-year Treasury yield. And in the financial world, where the Treasury yield goes, mortgage rates follow. The math behind this is brutal, and it is destroying the middle class. A mere 1% increase in mortgage rates mathematically slashes a home buyer's purchasing power by 10%. Think about that. A $500,000 home at a 6% interest rate costs the exact same monthly payment as a $450,000 home at 7%. The money hasn't disappeared. It has simply been consumed by the cost of debt. To make the algorithm work, either the interest rates have to drop or the price of the house has to fall through the floor.
But this collapse is not happening everywhere at once. The housing market of 2026 is a strange, fragmented patchwork of total desperation and quiet resilience. If we look at the heat map, we see a tale of 2 entirely different realities. In pandemic boom towns like Miami and Austin, panic is setting in. In Miami, there are currently 197% more sellers than buyers. The inventory is choking the system. But if you look at older, colder cities like Milwaukee or parts of New York, prices are actually creeping up. Why? Because of one word: affordability. In a high interest rate environment, capital flows like water to the path of least resistance. People are abandoning the overpriced Sunbelt simply to find a mortgage that doesn't consume half their income.
But if you want to see the real boogeyman of the 2026 housing market, you have to look at condominiums. The condo market is getting absolutely crushed. In some specific regional markets, there are 83% more condos listed than there are human beings willing to buy them. Why? Because the hidden costs have exploded. Between skyrocketing insurance premiums, which are now averaging $3,200 a year in states like Florida, and violently surging homeowner association fees, the math has broken. You are no longer buying an asset, you are buying a liability. For thousands of people, the affordable condo dream has morphed into a financial prison they cannot sell their way out of.
And this brings us to the most dangerous illusion of the current market, the dollar deception. Even when the mainstream headlines say that home prices are stable, they are lying to you through omission. You are witnessing a real terms correction. Most people see a news headline stating that home prices rose by 0.3% this year, and they breathe a sigh of relief. They think their equity is safe, but they are forgetting the silent thief. When you factor in a baseline inflation rate of 2.4%, that house didn't gain value. In real purchasing power, that house actually lost 2.1% of its value. For the first time in years, wage growth is finally outpacing home prices. Economists sitting in ivory towers call this a healthy normalization. They see it as a necessary cooling of a hot engine. But for a homeowner sitting at their kitchen table, watching the real value of their primary asset slowly evaporate into thin air, it doesn't feel healthy. It feels like a slow-motion car crash, a sideways grind that bleeds your net worth month after month.
As the market freezes, the pressure on Washington to do something has reached a boiling point. The system is locked, and politicians are terrified of a stagnant economy. The current administration has proposed a radical blueprint to artificially thaw the market, deploying 4 distinct strategies. First, the $200 billion buyout, a massive capital injection designed to artificially lower rates. But history shows its effects lasted only days before the market swallowed the liquidity. Second, banning Wall Street, a popular political talking point aimed at stopping institutional investors from buying single-family homes. It sounds great on television until you realize that Wall Street only owns roughly 1% of the total market. It is a scapegoat, not a solution. Third, portable mortgages, the idea of allowing a homeowner to take their magical 3% pandemic interest rate with them to a new house. It is a beautiful dream for buyers, but a catastrophic balance sheet nightmare for the banking sector. And fourth, building on federal land, repurposing 28% of government-owned land for affordable housing, a massive logistical undertaking that could take a decade to actually bear fruit. Here's the harsh truth about all of these proposals. None of them are silver bullets, because cheaper financing does not fix the root disease of affordability. It simply gives desperate people permission to overpay.
So where does this leave you? Is the sky falling? Are we heading for a catastrophic 2008-style collapse? Not exactly. We aren't seeing a wave of massive foreclosures because, unlike 2008, today's sellers actually have strict lending standards and massive amounts of locked-up equity. They are not forced to sell. They simply refuse to. They are holding the market hostage. But make no mistake, the era of easy money is dead. The days of buying any dilapidated property in any random zip code, throwing some gray paint on the walls and getting rich 6 months later, those days are over. In this new ruthless landscape, location and mathematical fundamentals are the only things that matter. If you are a buyer in this market, you must be tactical. Look for new construction builders who are desperate to clear inventory. Some are offering massive incentives, throwing up to 14% at buyers just to close a deal and get the liability off their books. And if you aren't ready to buy, there is absolutely zero shame in renting. Renting is not throwing money away if it protects you from buying at the top of a frozen market. Rent, aggressively save the difference, and wait for the gears of the machine to stop spinning.
The housing market isn't just a place where we live. It is a direct reflection of our economy's soul. And right now, that soul is undergoing a massive, painful, but mathematically necessary reset. The glitch is being patched. Do not get caught in the emotional hype. Run the numbers. Think long-term. Because in 2026, the most profitable move you make might just be the one you don't make at all.
If you want to understand the invisible data driving your money and stay one step ahead of the Great Reset, hit that subscribe button. We are building the ultimate blueprint for navigating the modern economy. Drop a comment below. Are prices dropping in your city, or are sellers still delusional? Let me know. Stay sharp, and I will see you in the next one.